Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Todd Sohn in the house.
That jacket is something.
Hey, buddy. You like it?
Miami Vice. I mean,
Todd, why are you hating? The world does not revolve around New York City. All right, I know in your head it does, but there are other cities with other cultures and whatnot. You should look into it. It's kind of a thing.
That jacket wouldn't fly here.
It's my Florida man jacket.
Dude, that jacket is sweet, man. That jacket is sweet. It's a bull market jacket. All right, Todd, give it to me. Listen, so Todd Sohn, for those of you who guys don't know, Todd Sohn, one of the best technical analysts on the planet. I'm happy to give you that credit. I love the work that you guys do there. So I want you to come in, just give it to me. What are you thinking about right now? What's on your head? We can get into your note in a minute. What's on your head?
So, and you guys were touching on this before with NVIDIA, with the largest weight, right? That's causing a lot of, I'd say, consternation, a little bit of frustration from our clients, because it's difficult to own that much of a single name, right? Owning 7% of Apple in portfolio is, goes against the guardrails, right? You can't really do that much. So there is a concern with that. And then the narrow leadership, right, which you can or can't agree with, is also a point of agitation amongst clients. And so I think really the most important chart now is equal weight S&P. It comes down to that.
I think the most important chart is the equally weighted S&P 500.
Yeah.
In what way? The relative trend or the absolute trend?
The absolute trend. Listen, equal weight stocks can outperform, especially coming off of market lows. They can underperform for an entire decade, like in the 90s. That's just part of how leadership works. I don't love seeing when the average stock goes down, though, while the big names go up, because then you're talking about real thinning participation, a market that is going on less and less legs. And Steve, we were talking about this the other day. This is the stars and the bench.
Yeah.
Right. The sports analogy that we love.
So wait, hold on. Let me give some context for this. A few years ago, we had a similar situation, Todd, right? Where everybody was complaining, we had the FANG acronym became a big thing, and everybody was complaining it's 5 stocks driving the market higher. And I remember you put out a note or said something, maybe we were just discussing it, and you told me the best players are supposed to score the most points. And I just love that. It's always stayed with me. We say it all the time, internally when we're talking. Explain what you mean by that. And then what that means about this thin leadership, and maybe it's not so abnormal or much of a concern at all.
Yeah. So you think about sports teams, right? We'll take the Heat. Jimmy Butler scores 30 points a game. He's supposed to do that. Jokic on Denver's puts up 30, 10, and 10. That's what he's meant to do that, right? That's what they're supposed to do. It's the same way with market cap weighted indices. These names have been voted the best names. They're the largest names. So they will obviously add to index gains when they go up. And it's become more and more magnified as you've gotten $1 trillion companies.
And if Jimmy's hurt, the Heat are going to struggle. And if Jokic, or if you're a Knicks fan, when your stars don't show up, you keep losing, right? When the stars don't show up, right? When like Randall, he didn't even show up in the series and they lost. If NVIDIA and Apple are struggling, the indexes are going to struggle too, right?
Yeah. So
out of this, Jason.
You like that Knicks dig there?
That was a good one. It's exactly what happened too. And so the stars are doing what they're supposed to do, and they're impacting the market cap weighted index. They're dragging it higher. You need to make sure that the bench, though, is still contributing in case those stars start to lag, get tired, consolidate, correct. You need to see the bench hold the team together. Yeah. And that's where the equal weight S&P comes in.
So the bench needs to participate, right? The rest of the stock market needs to participate, but they don't need to lead. And frankly, it's hard for them to lead, right?
Duncan Robinson's not going to drop 40.
He could once in a while. I wouldn't expect it every day. Listen, energy can rally, financials can rally, but I wouldn't look for them as maybe secular leaders right now in terms of Duncan Robinson type of thing.
Todd, the bigger problem for me isn't about 5 stocks are leading. It's more about for money managers or RIAs. How do you beat the market when the big boys are doing what they're doing? Unless you're going to create a portfolio that basically mirrors the indexes, aren't you going to have a tough time beating the market?
It's a really tough time. Everyone's different. And then it comes down to risk. Are you comfortable owning more than 14% combined of Apple and Microsoft, because that's what they are in the S&P right now. Are you going to say, okay, I'm going to own 25%? So that's really difficult. Or you got to go to other areas of the market. You got to go abroad, go to Japan.
I was going to say, you took the words right out of my mouth. Let's talk international. Japan, Europe, Germany, new highs, France, Denmark. I mean, can we talk about the international strength and what you're seeing there and what that means to you?
So let's start with Japan. It is, you can make the case Japan might be the best looking chart out there, right? We've been here before. Japan always bases, it goes up. It's the broadest. There's some 70 to 80% of stocks above the 200-day in the topics. And what I like about Japan, showing you the chart here, over the last 10 years, Japan and China, they kind of rhyme together in terms of performance, but all the attention has been on China. This is just a small slice of the investment world with ETF flows. About 29 billion into China over the last 10 years, minus 2 billion into Japan over the last 10 years. Now, I think Japan is way more timely, and I think you'd be surprised. We always get attention in client conversations on China. There's a growth story, whatever it might be. But if you go back over the last 30 years for China, the annualized return is less than 1%. And that's basically terrible. And you're getting immense volatility there. Right. And we've seen what happened to Tencent and Alibaba over the last couple of years. They've been, really rocked there, and that's hurt their market. And so I think there's way more attention focused on EM in China than there is on Japan. I like that from a sentiment standpoint. In Japan, when you go through all the names, there's way more names that are breaking out than looking very toppy at all. The constituency is great for Japan too. It's not too heavy tech. There's a lot of industrials which are working. There's a lot of good consumer names like a Sony and Nintendo. It's way more balanced than, say, the S&P 500. Europe, yesterday had a first crack, right, downside move there, but similar scenario. You don't have that big tech exposure. It hasn't worked in, call it 2 decades, right? The European luxury names have been on fire. That's the better way to play China, by the way. If you're too afraid of Chinese markets, play the luxury names. I know they're pausing here. That's okay, because they get a ton of their revenue from China. Think about LVMH, Dior, Gucci, names like that, right? Kering. Those are the best derivative ways to play China. So I think that's a meaningful alternative for investors who are saying, okay, I'm a little afraid of what's going on here with the big weights, what that's worth.
You know what's interesting, Todd? When you talk about emerging markets, because the strength that we've seen has been in developed markets. I mean, Europe's up like 50-something% in the last couple of quarters. Like, these are astronomical returns. People were telling me we're in a bear market. When we talk about emerging markets, it's really been the laggards. But you know what stands out to me? That it's not like China. It's not like, oh, China, and the rest of emerging markets are doing good, but China's not good. Or, China's doing great and the rest of emerging markets are not. Like, they're kind of like all, Latin America, China, like they're all kind of in the same boat. Anything stand out in emerging markets that's not struggling, or, you want to touch on the fact that they're moving in sync, or you see any differences between the different regions?
EM has just, you got to blow up EM and reinvent the whole scheme of it, because there's too much China, and you're seeing EM ex-China products start to really come out from a lot of issuers. I think there's been 4 or 5 this year. So that's helpful.
What is it, 40% in the MSI index?
It was 40
something.
It's down to 30. It was 40 back at the peak of, say, Baba and Tencent.
Yeah.
Way too much cases play active EM, but there's so many stocks there. But I do like what is going on from, you look at Taiwan, right? That's Taiwan semi, basically. Nice move overnight. Korea, Samsung also trying to bottom out and turn here. That's probably a better opportunity than playing China. LATAM, I don't know. I always struggle with LATAM. It's too messy for me. I mean, Mexico's been great. We can talk about that here. Go ahead.
Do you look at China and think, oh, China's weak, that's not good for international equities at large? Or do they just kind of beat to their own drum and do their own thing?
I think that used to be the story. Like, oh, all these companies have exposure there. And now it seems like over the last 3 years, especially with COVID, just in real world type stuff, everyone's moving out of there.
Right.
Like this, think about supply chains and whatnot.
Deglobalization.
Exactly. And so I think the market is moving on from that and realizing it's a mess there. The market is all over the place. and we're becoming less and less influenced by what's going on. Like Chinese markets don't look great right now. The equities are bad. The yuan is weakening.
New lows yesterday for FXI.
Yeah, not great. And it still gets a lot of attention though as a region in conversations because of the growth story or whatever you want to call it.
Well, Todd, what about the Nifty 50?
Nifty 50 is interesting. I think if you get growth to really come back here, we're seeing with NVIDIA, Apple, Microsoft, if that starts to expand, you can talk about the ARC names too. NVIDIA, India should be a beneficiary of that. Like look at Tata Motors, that's actually one of the better auto stocks around the world. Autos here are kind of pretty murky. Tata's pretty good.
Yeah.
You buying this pullback in Toyota? Speaking of Japan?
I think Toyota's trying to turn. I like Honda a little bit better. And the European autos a little sloppy recently, but they're also better than the U.S. counterparts too. So.
Where do you put India in the whole emerging markets world? Is it kind of like its own animal, or you think it fits in normally, or what?
I think if you're looking for non-Taiwan, China exposure, then that's your place to go, right? That little corner of the Asian geography, if you wanted to get away from there, look to India, especially while LATAM, your other option is just kind of all over the place. It's a big market. There's some decently sized name there, so liquidity shouldn't be too big of an issue. I know there's some restrictions on the stocks there locally, but that's another growth area if you're really looking for something ex-China. It'll have a significant weight too.
I want to circle back to what you were talking about originally on the equally weighted S&P 500. It looks just like industrials, right? If you look at the S&P industrial sector and you overlay the equally weighted S&P 500, they look exactly the same. So is that not what we're talking about? So in the back half of last year, you saw a lot of strength out of industrials and a lot of the more value-oriented names. And by the end of the year, it was really only the growth stocks that were not participating in the rally. And then all of a sudden, coming this year, you got the rotation into growth, and it's just been a monster ripper, and you're getting that sector rotation. I want to hear your thoughts on if this is a bull market, if this is a healthy market environment, do we absolutely need that rotation into industrials and into the more value-oriented areas immediately? Like, does this need to happen like now? Or it could be a situation where growth continues to drive the market, into maybe the back half of the year, and then eventually you get the rotation. Does it need to happen sooner? Because I tend to lean like we got to see some rotation soon, I think. Now, small caps, industrials, financials can't be breaking last summer's lows. Small caps can't be breaking last summer's lows. Like, this needs to happen now, no?
Yeah, you said it right there. As long as they don't break the lows, okay, we're in decent shape. Growth can continue to work higher, but eventually, yes. I think it's hard to put an expiration date on when you need to see a little bit of rotation. The longer equal S&P industrial spend sideways, the more frustrated I think people will get, more nervous, which actually in a way will create a sentiment tailwind, right? If you think about that, people will start getting really bearish. But yeah, eventually you
mean they're not bearish enough right now?
They're pretty bearish by my work.
Before we let you run, talk to us about sentiment. You say by your work, sentiment is pretty bleak. You're looking at that as a tailwind for equity prices higher. Why don't you walk us through your thought process there on sentiment?
So I think we all know about the futures positioning, deep short there. I don't know if there's a complicated reason for that, but it's short, right?
Yeah, but Todd, they're hedging their long positions in tech.
Yeah, that's what people
don't buy that?
I don't know. It seems pretty aggressive to me.
Agreed.
Flows to equity ETFs are very restrained this year. One of my favorite charts here up on the screen. If growth outside of these mega cap names was getting very aggressive, you'd see it in ARC. That is candidate number one for saying, okay, sentiment towards the growthier corners of the market coming back. There's been no flows to ARC over the last few weeks as it's perked up.
So you
think ARC is still a good benchmark for that? You don't think it's lost its luster? You think it's still a good benchmark?
I think it's still a very good benchmark for the really long duration assets, the really growthy corners of the market, Apple, Microsoft, your Tesla, Roku, Zoom type names. I look at that. There's nothing there. I look at broader equity flows. They've been very restrained this year. There's more money going into bonds. All the rage is about money market funds. Every single conversation we have is, well, what about money market funds?
Dude, seriously, I've never seen so many people excited about cash in my life, man.
Exactly.
Dude, for real.
5% is good, right? That's actually halfway to a decent equity year. But so you add that all up together, and that creates the type of sentiment tailwind. I think that is very favorable. Maybe the survey data is not washed out like you see at prior lows, but
we're coming off of washout levels.
Yeah, true, which would mean a helpful readjustment. But I just go back to the money market thing. Everyone is talking about money market funds. We haven't had that in a long time.
I got Howard Lindzen calling me bragging about his 5% on his money markets. I'm like, what is this world coming to?
So you look at that, you look at kind of the sloppy tape from corners of the equity market, and I think that's a really favorable backdrop. We just need to see the rest of these stocks start to participate, the bench get involved.
We never got to see an expansion in the new highs list, right? That would be nice. A nice addition.
Yeah. If you get a couple of good weeks from stocks, that'll expand.
Because we're right there.
You're in the red zone.
Yeah, you're in the red zone. I like that. I love your sports analogies, Todd. Right between Todd Sohn and John Roque. When it comes to the sports analogies, two of the best in the business.
He's an influence for those analogies on me, I think.
Yeah. Two frustrated Knicks fans, bringing it into the markets.
We should do a dual interview. We got to get Roque on here next week to talk about this Mendoza line of his.
True. It's true. All right. Fun Police is here to kick Todd out. Todd, if you had to buy something this week before the week's out, what are you buying? Give it to me.
NVIDIA.
Okay. All right, you and everybody else apparently.
I think they take a look at some of those ARK funds. They're interesting. I mean, you could get really burned by them if this is not real bottoms.
One more. I know you look at a lot of analysts. Sorry, Spencer. I know you look at a lot of analyst ratings. Todd, anywhere stand out where they're just not getting any love, or maybe they're getting too much love?
I think really the broader market, honestly. I mean, you look at some of the average S&P targets like flat right now.
So the revisions, you're noticing all the revisions keep going higher. Classic bull market behavior.
They're starting to do it because you have to, especially when these big names start moving that up. That creates a tailwind for the index. You just got to see the bench get involved.
Well, have you guys done any work around, the percentage of stocks that are actually seeing positive reactions to earnings this quarter? Because all I'm hearing about is earnings recessions. And then I get to my desk every morning and I look at the stocks that are reporting earnings, and I'm seeing a lot of breakouts on earnings. So
off the top of my head, I don't. My buddy here behind me, he's the guy who's the keeper of all that, so I can ask him.
Well, we'll have him on next time. All
right, Todd Sohn is the ETF and technical strategist at Strategist Securities. Todd, always a pleasure, man.
Thanks, Todd, man.
Good to see you.
I can't take no loss. I don't even know what it